Did you know that every day the world's biggest banks lend money to each other just to get through the night? It's like a giant financial dormitory. One bank lends, another borrows, and the next day everything falls into place. But what nobody tells you is this system is fragile, very fragile. If, for any reason, banks stop trusting each other, everything stops. And when that happens, the first domino to fall is your invested money. Stocks, real estate funds, dividends flowing into the account. All of that depends on a banking system that works like clockwork. If it fails, the gears stop turning. Now imagine you're relaxed with your investments set up, thinking you're building wealth, and suddenly banks stop lending to each other. The wheel locks up. And then who needs to save everything? Federal Reserve, the central bank of the United States, comes in and injects billions of dollars into the system like someone throwing water on a burning house. This type of intervention seems distant, but it affects every penny invested by you, no matter where you live. Because when the banks lock down, stocks plummet, funds dry up, and the dividends you expect simply evaporate. This can happen again and again and again. That's why understanding these signals is a competitive advantage. While most people don't even realize it, you can position yourself, you can protect your capital, and even better, you can prepare to seize the opportunities that arise when everyone else is panicking. Because one thing is certain, whenever the Fed steps in, the winds change, and those who pay attention profit. Now you might be asking yourself, but what exactly is this thing called repo market that can stop everything? Think of it this way. The repo market is like a big flash loan between banks. One bank has securities as if they were valuable paper like US government bonds. Another bank has money. One lends the security, the other lends the money, just for one night. The next day, they exchange them back. Simple, right? But there is one detail. This system is based on pure trust. And what happens when that trust breaks? Everything stops. Money stops circulating. And the banks, which are the economy's major distributors of credit, go into panic mode. When this happens, it's not just the system that feels it. It's you. Your real estate fund does not receive rent. Your favorite company delays dividends. Your stock plummets without you even knowing why. And you know the worst part? The average investor doesn't even realize that it all started because two banks couldn't trust each other for one night. This is the kind of thing that no one teaches you when you start investing. But if you want to play at another level, the level of someone who builds solid wealth, lives off dividends, and has peace with money, you need to understand where you're stepping. When you see the Federal Reserve entering the repo market with billions in hand, that's not just a technical action. It's a sign, a warning. It's as if a firefighter is approaching the building. You can run or you can climb to the top and enjoy the view. The choice is yours. Want to master the money game and protect your future? Sign up now and learn the strategies top investors use to win even in the toughest times. What happened in 2019 and why it's about to happen again with your money in the middle. If you think all this is exaggeration, that banks know how to get by, that the system can handle any blow, let me tell you a true story, and a scary one. In September 2019, the repo market in the United States just froze. The banks woke up one day and discovered that no one had any money left to lend. Everyone was holding onto their cash as if something bad was about to happen. Do you know what this caused? The Federal Reserve had to rush to the rescue of the system, injected billions overnight, and more began to cut interest rates quickly. The objective was only one: prevent banks from failing and a domino effect from reaching you. And it arrived. From then on, the Fed began a series of cuts and liquidity injections. And what happened next? The stock market soared, cryptocurrencies rose, real estate appreciated, dividends grew again. It seemed like magic, but what really happened was a chain reaction triggered by behind-the-scenes panic, a small collapse hidden from the eyes of most, but which transformed the global financial landscape. Now, why does this matter? Because the same signs are reappearing now. The story is 5, and if you don't pay attention, you'll be in the wrong place at the wrong time. On the other hand, if you see the signs and know what to do, you will be buying assets when they are cheap and receiving increasing dividends, while others are still confused. The difference between winners and losers in the market, it's not luck. It is vision and preparation. The invisible cycle that swallows profits and turns dividends to dust. There is a secret game at the heart of the financial system, a game most people don't even know exists. But this game defines whether you will prosper with your investments or see your passive income evaporate without understanding why. This game is called liquidity. After the 2008 crisis, the Federal Reserve flooded the system with so much money that for years the banks were left with surplus cash. There was so much money in the system that the banks didn't even know where to put it. The result? They started returning the money to the Fed itself, parking it in a place called the reverse repo market. Yes, instead of lending to each other, they started holding the excess with the central bank. And the Fed still paid interest on it. But here's what nobody tells you. This excess liquidity created a false sense of security. Meanwhile, stocks were rising, dividends were flowing into accounts, real estate funds seemed magical, but it was all sustained by a flood of easy money that at some point had to end. And guess what? He finished. In recent years, the Federal Reserve has begun to pull the brakes. It has cut back on excess. It has stopped printing. It has started selling assets. And the liquidity that once flowed like a waterfall dried up like a river in the desert. What does this mean to you? It means that without liquidity, asset prices fall, dividends shrink, unprepared investors become statistics. But it also means that whoever understands the cycle and acts intelligently can position themselves at the turnaround, buying valuable assets when they are on sale and multiplying wealth when the next liquidity cycle begins, because he will begin, and when you start, the same mistakes will repeat themselves, or you will be one of the few who profit from it. Imagine that the global financial system is like a giant dam. For years, this dam was overflowing. The Federal Reserve, the guardian of this dam, opened the floodgates and let the money flow. It was an era of plenty, banks swimming in liquidity, companies with easy credit, financial assets rising like rockets. You may have experienced this phase. Fat dividends, rising stock prices, real estate funds seeming infallible. But do you know what happens when you open a dam too much? Sooner or later it dries up, and that's exactly what happened. Between 2020 and 2022, the Fed poured trillions into the system to save the economy. But this mountain of money wasn't free. It brought inflation, distortions, and bubbles. Then came the turning point. The Fed has started to tighten its belt. He reduced his balance sheet, raised interest rates, and dried up the taps. What about the liquidity dam? It started to empty. Today, the situation is the opposite of before. The banks, they have no more left. Money disappeared from the system like water evaporating in the sun. Result? Small and medium-sized businesses struggle to obtain credit. High interest rates erode profits, dividends decrease. Because profits decrease, real estate funds face vacancy, default and devaluation, and the investor who thought he was at peace wake up in a silent storm. Most people don't even notice this change until it's too late. But not you. You're seeing it now. It's ahead. Because when the dam runs dry completely, the Fed will have to act again. It's going to release money again. It's going to loosen the reins again. And whoever is prepared will be on the front line, buying cheap what everyone will want later. Don't get lost when the market turns. Click the subscribe button and learn how to surf the financial waves safely and intelligently. If you've paid attention this far, you'll already understand that the global financial system works like a tide, sometimes full of liquidity, sometimes dry as a desert. And what marks this turning point? A sign, subtle, technical, almost invisible to most, but powerful for those who know what to look for. That sign appeared again. The Federal Reserve has again intervened in the repo market. And that, my friend, it's not routine. It's a cry for help. The last time this happened in any significant way was in 2019. Shortly after, the Fed cut interest rates. Money started flowing again. And what happened? Stocks soared, real estate funds appreciated, crypto exploded, and dividends grew like never before. Now, guess what? The Fed intervened again, discreetly, as if he didn't want to attract attention. But for those who understand the game, it's like hearing the creak of a door opening, the gateway to the next major appreciation cycle. It's the same script, just with new actors, and you can choose which role you want to play. The investor who ignores the signs and misses the boat, or the strategist who anticipates, positions himself, and makes capital work for him. Because when the Fed starts putting money back into the system, the impact is always the same. Assets rise first, profits appear later, and dividends follow suit. The question is, will you be on the edge of the wave waiting, or will you be dragged along by it? Have you ever noticed that every time the Federal Reserve steps in to put out a fire, he doesn't just throw a bucket of water, he floods the entire system, and that changes everything. The story shows, with frightening clarity, what usually happens right after these interventions. Interest rates begin to fall, quickly and unexpectedly. The monetary tightening stops, and the Fed slows the withdrawal of money from the system. In some cases, they even start printing money again, covertly, of course, but the actual effect is always the same. Cheaper and more abundant money starts to circulate again. And you know who realizes this first? Who has real money? Institutional investors, billion-dollar funds, and major market players act before any official announcement. They buy assets while the public is still afraid, and they reap the benefits when optimism returns. Too late for those who waited for the right moment. But you don't have to be a billionaire to act like one. If you understand the cycle, if you see the signs, like this new intervention in the repo market, then you know what's coming. Gradual reduction of interest rates, credit relief, expansion of risk assets, and dividends are recovering in the wake of companies that are breathing again, but only if you are already positioned. Anyone waiting for confirmation will miss the best part of the party. This is the time to ask yourself, am I acting like someone who anticipates the movement? Or like someone who reacts late and hopes for the best? Just imagine, the Fed releases money, interest rates fall, and everything starts to happen. But it's not magic, it's cause and effect. The first thing you will notice is that asset prices, stocks, real estate, cryptocurrencies, everything, will rise quickly. This happens because new money enters the hands of those who have the power to buy, large, wealthy investors. They do this to protect and grow their assets. And do you know what this means for you? Dividends will start to improve, and so will corporate profits, because larger, stronger companies can take advantage of these easier credit conditions to grow, invest, and increase payments to their shareholders. But there's one catch. This rise isn't eternal. It's a wave. First it rises, then it inevitably falls. And that's where the trick for the smart investor comes in. Don't get carried away by the euphoria of everyone is winning. Maintain discipline to reap the dividends. While the tide is high, preparing for the moment when the tide goes out, which it always does. This boom-bust cycle is like a tide game, and those who understand it know exactly when to surf and when to get out of the water. Because true security for your pocket is in diversify. Focus on solid dividends and avoid the fad frenzy that can leave you hanging when the party is over. When the Federal Reserve begins injecting money into the market because banks can no longer lend to each other, it's a clear sign that the financial system is tightening and that something is wrong. This tightening means that money is becoming harder to come by, which can hinder investment and, consequently, business growth. Therefore, the Fed usually responds by easing conditions, lowering interest rates to make loans cheaper, and even starting to print money to ensure there's sufficient liquidity in the system. This creates a temporary scenario in which credit becomes easy, and asset prices, such as stocks and real estate, begin to rise rapidly. Savvy investors know this is the time to position themselves to take advantage of the dividends and gains that come with this money-rich environment. However, this ease doesn't last forever. After a while, inflation begins to rise, and the Fed needs to tighten its belt again, raising interest rates and withdrawing liquidity, which can drive down prices and trigger a decline in investment. For investors, understanding this cycle is crucial. You need to take advantage of boom times to reap dividends and grow your wealth, but always be prepared for the inevitable adjustments that will come, avoiding the risk of losing everything when the bubble bursts. Maintaining discipline, diversifying, and focusing on quality assets is the key to navigating these waves and protecting your money from unexpected crises. From 1980 to 2020, the world experienced a period where interest rates fell and inflation decreased, allowing money to remain cheaper for a long time. This helped businesses, investors, and families grow with confidence. But starting in 2020, this cycle changed, and we are entering a completely different phase, where interest rates and inflation tend to rise. This isn't just a matter of economic policy, it's a structural change that could last for many years. It's as if the clock has been turned back to a time similar to the 1940s to the 1980s, when inflation was higher and the cost of money was also higher. For investors, this means that dividends and returns will have to be considered within this new context, where money becomes more expensive and the risk of inflation erodes the value of your investment. But, at the same time, this phase brings opportunities. Those who know how to position themselves in assets that protect against inflation and focus on consistent dividends can not only survive, but thrive even with this volatility. Understanding this cycle is key to not being caught off guard, because it dictates how money will circulate, how prices will behave, and ultimately how your investment will grow or shrink. Now, let's talk about what this all means for you, your money, and your day-to-day investments. When the Federal Reserve starts easing things up, lowering interest rates, putting more money into the market, you'll see a run on asset prices. Stocks, real estate, cryptocurrencies, everything starts to rise rapidly. This may seem like the perfect opportunity to make easy money and watch your dividends grow. But here's the catch. This euphoria doesn't last long. It's like candy that seems too good to be true, and it usually is. If you're not careful, the feeling of FOMO, fear of missing out, can lead you to invest impulsively, jumping into bubbles that, when they burst, take your gains and cause heavy losses. Therefore, the key is to ride the upswing, yes, but with discipline. Invest in solid assets that pay real dividends. Don't fall for passing fads, and always maintain good diversification. This way, when the cycle turns and the hard times arrive, with high interest rates and falling prices, your portfolio will be protected and you'll be able to weather this storm without losing everything. This balance between enjoying the good times and preparing for the bad is what separates investors who thrive from those who lose everything. Now that you understand how the money cycle can cause asset prices to rise and fall, it's important to know that the Fed also has a button to try to stop this roller coaster, the famous quantitative tightening, QT. When the Fed tightens its grip on money, it essentially stops reinvesting its bond earnings and lets the money disappear from the system. This makes credit more expensive, interest rates rise, and access to cash more difficult for banks, businesses, and investors. And guess what? This can lead to falling asset prices, lower dividends, and a crisis of confidence in the markets. But that's not all. When the economy tightens, the Fed can even return to quantitative easing, QE, which is the opposite. They print money to buy assets and facilitate credit, injecting money back into the system. It's like a remedy for crises, but it comes with side effects. Higher inflation, distortions in asset prices, and in the long run, it can increase the risk of financial bubbles. For investors, understanding this dynamic between QT and QE is crucial. Knowing when the Fed will tighten or loosen its grip can be the difference between earning good dividends and protecting your assets, or watching everything collapse before your eyes. The key is to pay attention to the signs, maintain a diversified portfolio, and invest in assets that are resilient in these cycles, especially those that pay strong and consistent dividends, which act as a safety net when the market fluctuates. Imagine the financial market as a big party, where sometimes there's plenty of money and everyone wants to buy assets, sending prices soaring. Other times, money is tight, and people struggle even to get credit or sell their investments, sending prices plummeting. These ups and downs happen in constant cycles, and understanding this dance is essential to protecting and growing your money. When the Fed injects money, prices rise rapidly, and many believe that investing has become a guarantee of easy profits. But this is only the beginning of the cycle. The truth is, then comes the decline, and that's when investors who prepared themselves with assets that pay strong and consistent dividends can hold on, receiving income even when prices fall. Investing without understanding these cycles is like trying to surf without looking at the waves. You could get thrown off course and lose everything, but those who learn to read these signals and adjust their strategy know exactly when to take advantage of the boom and, more importantly, how to protect themselves from the inevitable bust. So, be aware, the market is a marathon, not a sprint. Diversify, choose dividend-paying assets, and maintain discipline. This way, you'll ride the market waves safely, building wealth steadily and solidly, even in the most turbulent times.